Hey guys, welcome back. In today's video, we're going to take a look at a live trade that I recorded this morning where I executed just a scalp trade on Amazon. Trading just one contract, was able to make a quick $180. What's different about this is you're going to actually see me talk about what I'm looking at in pre-market just before the bell rings. And then you're going to see me actually trade Amazon and try to talk to you during the process while I'm actually recording. You know, you'll have to forgive me. This is something new to me. I usually like to record my screen for learning purposes. I can go back and analyze, and then usually I like to share that with you, that post analysis. But just to do something a little bit different, similar to the last live trading video that I did on the SPX zero data expiration trade, I thought you guys might enjoy something a little bit different there. Once we look at that video, we're going to come back and we're going to go over some trades that I took on SPX zero data expiration today, where I'm actually finishing down $1,180. Made a lot of mistakes, and it was very long. It was a lot of trading throughout the day. So I'm just going to condense it down. We're going to go over the trades that I took and see what lessons could have been learned from that. And with that, we will go ahead and roll the intro and get started with the live trade on Amazon. Good morning, guys. Looking at a few stocks and possibly a zero data expiration trade on SPX. So on Apple, you know, it's perking up here, so I like if it can start moving up over this 20 MA. You can see it's testing the 90 MA now. We could definitely see a move back up to these highs here and eventually maybe up to this 126 on the daily chart. So we'll have to probably be patient with that and see what that does off the open. Amazon going to upgrade today. Kind of the same story. It's got some congestion overhead. I actually wouldn't mind this one to pull back to around 30-20 area, so we'll keep that on watch. Baidu was another one I wanted to take a look at for a possible continuation bounce today over previous high day. Ideally, it would pull a little bit and not just go. It does have a 100-day overhead, so we probably will have to be patient on that as well. We have about 30 seconds till the market opens here. S&P futures pulling back a little bit, filling in some of that poor distribution I talked about in the market profile here. But otherwise, it could push up higher today. So I want to be patient as well for any zero data expiration trade. So off the open, I'm going to be watching Apple, Amazon, Baidu, and see what BA is doing this morning. BA is actually looking pretty good too. So BA might be a good play over pre-market high. It's right at previous high day as we speak. So we'll put that on the chart too. It's already up there. All right, so we are good. So let's switch over here and we'll see if we catch anything off the open. Amazon looks like it's going to go here. I'm going to get in on Amazon right here. $3,100 calls. Bit out of the money, but obviously they're pretty expensive. So and if Apple can flag pretty good here, I might look at getting in on that one too.
255 calls. April 1st, 2021. 255 contracts.
So we got filled at 1820. See if we can get these out at 2020.
Spike 387
2025.
puts. April 9th, 2021.
Nice push.
926 BA.
So I'm on the ask at 2025 for Amazon here.
April 1st, 2021.
See if we can get one more pop up. Should get that filled. 1980 on the ask there. Looks good. Hitting the 20 MA right now, that's the only thing. AMD, opening range breakout. So, last push up here, there's 20. May have to drop that a little bit here on Amazon. Let's get out at 20. because we're pausing here at the 20-day. There we go. All right, so we got that filled on Amazon. Quick 180 there. It's definitely not done, but obviously it's right into the 20-day. So, and you've got the 9-day just right overhead, right? So it may make it up there, but you know, I don't like to play around too much with Amazon. All right, guys, so hope you enjoyed that live trade on Amazon. It's definitely something different. And for me, it's a little bit different talking to the camera while you're trading in real time. I try to share with you any of my screen recordings where there's good lessons to be learned, where we can kind of analyze things in hindsight, but there's always an interesting element to seeing trading in real time and getting those reactions, if you will. So let's jump into my Tastyworks account here and just review how the day went. Obviously, you can see it's pretty much a bloodbath here, down $1,180 overall on SPX. So giving back all of Friday plus more, right? So when we look at this, there was a lot of trades that were put on here, but the one in particular that got me right here, this is the one that got me. This was a call leg. I shorted that 39.75 strike, and the price came right through it, and they went into the money, and I really got exposed to that gamma risk. Now, gamma is not something that I've really talked about with you guys when it comes to trading options. I didn't cover it in my options course, but it is something that I've learned more about since I've got into doing these spreads, and something that we should definitely talk about. We know that delta tells us how much an option contract is going to increase or decrease in value based on every 1 point move in the underlying. Well, gamma basically defines how much or how fast delta is essentially going to change. So when you're trading contracts that expire that day, of course, this is a 0-day expiration trade, those contracts are especially vulnerable to gamma risk when they are near or right at the money. So if you have an option spread like this where I'm essentially short, I'm looking for those contracts to lose all of their extrinsic value, and you have the underlying that moves in the wrong direction, it moves toward your spread and starts to threaten your spread, then that gamma risk gets greater and greater. And then if it moves toward your spread with speed, then you get that volatility, that vega risk thrown in on top of it. And those premiums on those contracts, and thereby these spreads, can really expand very quickly. And you can be looking at a pretty big loss incredibly quick. So before we jump into the trades, I just want to walk you through, if you're not familiar, the concepts of this 0-day expiration trade, because I think that, you know, it's very interesting. It's very tempting to do something like this, but it's very important that we understand the risk involved with this. So the first trade that I took was actually on the put side. So let's just try to recreate that as best as we can. We're going to use a different expiration date, obviously, but let's see. I usually go for about the 15 delta. So right here we've got a strike here, the 39.15 strike that's right at a 15 delta. So if I were to short that and then come in 2 strikes above it, so a 10-point wide spread, and we go long the 39.05, that creates our vertical spread. So I shorted the 39.15 put and I went long the 39.05 put. Now obviously what this means is that I want the underlying, in this case I want SPX to stay below. I want SPX to stay below my short strike. I really hate whoever created the option chain, by the way, that they made this backwards. You see these strike prices, you have calls on the left and puts on the right. So the price of the underlying is increasing when you move down the ladder, and the price of the underlying is decreasing when you move up the ladder. It's completely backwards. What were they thinking? But anyways, when we look at this, obviously this is the structure of the trade, right? So in this case, this is usually what I do. I do a 10-point wide spread here, and this defines the spread. And so if, in this case, SPX starts to trade toward your spread, toward your short strike, you're going to start losing money. As it moves up towards your short strike, you're going to go red, even though as long as SPX closes below your short strike, as long as SPX closes below that short strike, you would make max profit. In this case, let me bump up to my usual lot size. So I usually go with 5 lots, right? So in this case, and let's also change it to what I got filled at. I got filled at $1.20. All right, so there we go. So in this case, with the first trade that I took, I got filled at $1.20. And if I had done a 10-point wide spread, you can see that I would have a max profit of $600, but a max loss of $4,400. So obviously the way these spreads are designed is that you're looking at incredible risk on that max loss side compared to what you're looking to make on your max profit side. So how do we manage that risk? Now, obviously this max loss is realized at expiration. Now this assumes that the underlying trades through your short strike and through your long strike and closes outside of your entire spread. If that happens, then you realize this max loss. As long as it stays below, you realize your max profit. Now that's at expiration. That assumes you hold to the close. You hold through the close, right? So during the trading day, you can manage your risk by basically using a stop loss. So as the underlying, as SPX trades towards your spread, towards your short strike, you're going to start losing money. And so the general principle that most people use is using a stop loss of about 2 to 3 times the credit you received. So in this case, I would have received a $600 credit. So the stop loss would be 2 to 3 times that amount, which is still going to be less than this max loss, right? So that's essentially how you manage your risk on these trades. Now the problem with that is that because of the gamma and that vega risk, if it comes up here, you're not only going to start losing money on the spread because it is actually moving in the wrong direction, it's moving towards your spread, but if it goes up there with speed, then you're going to start getting that vega risk along with the gamma risk, and the pricing of the spread, the pricing of those contracts can expand so quickly that you'll be looking at a substantial loss by the time it gets there. You know, not your max loss, but you'll still be looking at a substantial loss that it just makes it a little bit difficult to get out exactly where you want in terms of your stop, but definitely doable, and I definitely could have done that better. So just as a demonstration purposes, this is how the trade looks, right? You will go in pain as the underlying trades towards your spread, but the idea is that as long as it doesn't go through your spread, you're still good, but it doesn't change the fact that you're looking at a serious drawdown as it gets up to your spread. Now, I did a 15-point wide spread today, which I wanted to just demonstrate in the platform here for you. Like I said, usually I do a 10-point wide spread, which is usually about a $4,500 max loss. Now, if we widen the spread, if we take our call leg and bump it up 1 strike like that, now we have a 15-point wide spread. You'll see that the max loss has increased to $6,800. So the wider you make the spread, the more risk you're putting on the trade, but the quicker the spread will decay, which again, we're shorting this spread. We want it to decay. We want to collect that credit and keep it. So the wider you make the spread, the quicker it will decay. And as I've said, in this market right now, it seems like time is our biggest enemy because of the risk of these whipsaw moves that can really cause havoc on the premiums of these contracts. So if we can get out of this trade quicker and just look for about a 50% capture rate, I think it's going to, we'll be better off. So since I widened the spread to try to get that faster time decay, it meant that obviously I'm putting on more risk. So I had to go down on my lot sizing to 3 instead of 5, which got me back to about what I'm okay to risk here, about $4,000 or so. So this is the concept of the trade, and this is kind of demonstrating the difference between the width of the spread and the purposes it serves. All right. So let's go back in here, and I'm going to detach this, and we'll pull this down to our chart so we can just kind of analyze this. All right. So again, I started in here on the put legs. I went in with the 39.30 put short and the 39.15 put long, which collected $1.20 credit on. So I feel like I was really patient. I didn't actually get into this trade until 10:46. You can see right there. And that is about here. It's about here on the chart when I got into this trade. So you can see that it initially started to work, But then I think I was up about 160 bucks. Didn't quite get to that 50% capture rate before this big red candle came crashing back down. Now, when this happened, I actually took the trade off. You can see right here at 11:09, I took the trade off for $1.20 debit. So I took it off break even. Now, the reason I did that really is not just because it pulled right there, but based on what I was seeing in the market internal. So let's hop over to that screen so you can see. So all morning long, right? All morning long, I see that the tick distribution here on the New York Stock Exchange is bearish. Every single candle closing below the zero line. You look at the NASDAQ, it's the same thing, right? All morning long, it looks bearish. Every candle closing below the zero line. Furthermore, if we look at the breadth for the New York Stock Exchange, you can see that it is also bearish. Very clear downtrend. We actually saw breadth about -4 to 1, which is those are bearish numbers. You look at the breadth for the NASDAQ, it's the same thing, trending down all morning, -2 to 1. You look at the advanced decline line here. After an initial pop in rejection off the zero line, it crashes all the way down to -1500. The advanced decline line is telling us the number of stocks advancing versus declining, in this case in the New York Stock Exchange. So it's the number of stocks advancing versus declining over or under the previous day's close. So this is telling me that the majority of stocks are declining. Obviously bearish. Same thing here on the NASDAQ, right? So we have these bearish readings all morning long on the internals, and so I was very patient, looking to see if we could find a bottom on the internals. And when I started in on that put leg was when I saw that we were starting to get some closes here above the zero line on the NYSE and a little bit here on the NASDAQ as well. So it looked like, and you look at the breadth here, it looks like it's starting to bottom a little bit. Thought, all right, this looks good. Same thing here on the NASDAQ. This looks good. Maybe we have found a bottom. And I saw the market profile. There was just a handful of contracts traded at the low of day. All of these signs pointed to a possible bottom. Now, looking at this in hindsight, I can see that was the bottom. But what I saw after that, and the reason I took off that put leg, was if we look at this here, let me zoom in on this for you. So when we look at this, we can see these two candles right here, these two 15-minute candles on the breadth for the New York Stock Exchange. This is right where it looked like it was bottoming. I'm in on my put leg. They start to come up. This one gets stuffed. This one comes up. Again, it gets stuffed, and it puts in a new low. So right there, I saw that. I also saw that the tick candle's getting back below the zero line again. I thought, maybe the bottom's not in. I don't want to get caught up in that gamma risk. Let's just play it safe. We'll take the put leg off and reassess. Maybe we can go ahead and start in on the call leg after all. So that's what I did. Took the put leg off and started in on the call leg. Obviously, that was the mistake. So let's go back over to our charts here. All right, so here's where I started in on the call leg. 11:15, I started in on the 39.75 call short, again with a 15-point wide spread, a 3-lot, filled at 95 cents. So that was at 11:15. That was right here on this candle right here. This is where I got filled on that call leg. And if we look, 39.75 was a short strike. If we go to the SPX cash index, because it's going to be a little bit different. The SPX cash index is 10 or 7 point difference from the futures, and I have no idea why. But here is the short strike right here, 39.75. So you can see, obviously, that got violated today. That 39.75 short strike right there actually went into the money on me today, which is why that loss was so substantial in that particular strike. So I'm in on that call leg, and obviously, the chart tells you everything you need to know. It ripped. It ripped. And obviously, with a 95-cent credit, that spread expanded in value dramatically. Well, this is the real mistake right here. This is fine. I started in on a call leg. Looked like the market was going to head lower. No problem there. Still good ways away from that strike price. No problem. Then I make a mistake here. So I add one more lot. So putting on a little bit more risk. So we're up to a total of 4 lots on that same spread. And you see I got filled at $1.80 credit. So first credit on 3 lots, 95 cents. Second trade on 1 lot, $1.80 credit. So they've expanded in value, but not too much. Well, look here. Not even what is that? A little over 10, 15 minutes later, I'm having to close those 39.75 calls that I'm short for a $4 debit. $4 debit from my original fill at 95 cents. So they expanded pretty big on that push up there. This is me just closing out the long calls that went with the short calls here. And then here, this was the next trade. I rolled up to the next call leg to 39.85 instead of 39.75, so really just 10 points away, which is probably not that far. But again, with the 3 lot, and I got $1 credit on that. Then we go here, I decided to add another lot to the 39.75 because I still had 1 lot on. I only took 2 lots off. And that was a mistake right here. I should have, right here where I took off these 2 lots, I should have just took off the whole thing. I should have took off that whole spread and then rolled up to the 39.85. And instead, I left 1 lot on and I rolled up to the 39.85. So that was a mistake for sure. Okay, so then we see here, that's where I added to the 39.75. So now I have 2 lots on that 39.75 leg and I have 3 lots on the 39.85 leg. And then we go here. This is where I'm unwinding the 39.75 leg for substantial loss at that point, 550 and 550 debit to get out of that. And then here I am unwinding, let's see, what am I doing here? Oh, sorry, these 3 here. These 3 here, I'm unwinding that 39.75 leg. It gets really convoluted whenever you have all these trades in here, as you can see. And then this right here is unwinding the 39.85 that I rolled up to. So I originally got a credit on that for $1 and I got out for an 85-cent loss there. So that was it. And then I left, got some lunch, came back with less than an hour in the trading day, and I took one more stab on this time the 39.90 calls with a 10-point wide spread. So I did 5 lots. So the same amount of risk, and because it was so close to the end of the day, this was 39.90 at 2:12. So we look at the chart over here. Let's switch this to a 5-minute chart. So at 2:12, that was, I guess that was right about here. Yeah, that was right about here. This is whenever I got in on that last one. So I did the 39.90, which if we look at the cash index here, cash SPX 39.90, that brought us above the all-time high. That brought us up to about here. So I did that because it was right at the end of the day. And what happens, obviously there is a lot of gamma risk because I am essentially close to at the money, but it's right at the end of the day. So as long as we get just the tiniest of a pullback, all of that extrinsic value that is in those contracts has to come out. And being that close to the close, just the tiniest of pullback, it's going to come out almost instantly. So if we go back over there, I was able to close it out. I didn't want to really risk holding it all the way through the close. So I got filled for an 80-cent credit and I closed it for 20 cents. So I was able to realize 75% of the profit potential. Max profit on that was $400 if I'm not mistaken. And I was able to realize about $300. So I made back a little bit of the loss, obviously small potatoes at the end of the day. But with that wrapped up a rather busy trading day on the 0 data expiration trade. So again, lessons learned is to just take the stop off, take the trade off at your stop. Don't take some off and add into it like I did here. I have a little spreadsheet here. Let's hop over to this view and you can see I haven't finished filling it out yet, but this was the first put leg that I stopped out on break even, and this was that 39.75 call leg. And I haven't finished filling this out, but you can see with 4 lots on that one, the stop price was supposed to be 348. Okay, that's automatically calculated at 3 times the credit received, and since I received $1.16 credit between that was my average between the first 3 lots I put on and the extra lot I added, so a total of 4 lots. So with $1.16 essentially trade price, my stop was supposed to be $3.48 premium, which would have been only a $676 loss. So you can see, obviously, by managing the spread in such a way, a $676 loss is way better than holding and hoping and just letting it expire with the chance of, or letting it expire outside of your spread with the chance of losing over $4,000. So I would much rather lose $676 by managing the spread with a stop loss than just holding and hoping that it doesn't go through your entire spread and close outside of your spread, realizing a max loss on it. So a lot of lessons learned there. I think the biggest takeaway is to stick to your stop loss 2 to 3 times the credit you received on the spread. Really important there. Take the entire spread off. You can roll up, but really you should add to the opposite side of the trade. So in this case, I should have added put legs in to help offset some of that loss from the call leg. And you can roll up to another call leg, but you have to take off the call leg that's being threatened first at your stop loss. Just realize that loss, readjust, and try to make some of it back. So then it really becomes trying to minimize your loss instead of trying to necessarily turn it into a green day. So I will wrap it up there, guys. Again, just kind of learning through this as we go. Hopefully it's helping you guys and showing you kind of the caveats of a strategy like this. Obviously there's no perfect strategy in the market. When you find something that looks really exciting and just almost bulletproof, it's almost never the case. So I hope you guys had a good trading day, and as always, I appreciate you guys following. Be sure and hit the like button if you enjoyed the video, and leave me a comment below. So take care, guys, and we'll see you in the next one.